Hello, everyone. Welcome to the final bar. Today, we're going to look at the overall market sort of hanging in there today after yesterday's sell-off and plenty of distribution data, especially with technology, communication services, consumer discretionary, all the leadership groups continuing to roll over. The market actually holding up decently going into the close, and it's driven by strength in financials, industrial. So seeing some charts in banks and otherwise regional banks, consumer finance, all starting to look a little more constructive. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down these markets in a week like this one. I feel very happy and fulfilled that I have charts to help me make sense of what's going on here. When we get caught up into could and should and things like that describing market activity, I think we run into trouble because that's where things like narrative bias and confirmation bias and the endowment effect and all these behavioral biases can creep into our process. By looking at charts and focusing on the momentum, focusing on when trends are shifting, on how they're evolving, and most importantly, not getting too caught up in the short-term movements of one day, but focusing on the long-term trends and how they're rotating. I think more than often you're going to be on the right side of things. You'll be able to weather any sort of crazy period like we're arguably seeing right about now. Now, coming up on StockCharts TV, particularly on the Final Bar, we have some wonderful guests this week. I was really happy with some of the guest discussions yesterday with Mark Young talking about sentiment. It was really interesting. Made me think a lot about the VIX and volatility. Next week, just so you know, we're going to be taking Monday off for Labor Day. Hope everyone has a relaxing long weekend, recharging and refreshing, and we'll get back to the Final Bar on Tuesday. On Wednesday, Fred Meisner from the Fred Report is going to be joining us from Atlanta. And next week on September 15th, David Settle from Market Scholars will be coming on the show for the first time. Also, as a reminder, our next big event coming up is called Introducing StockCharts ACP. That's coming up on September 22nd. We've captured some fantastic discussions recently with John Murphy, with Martin Pring, Larry Williams, Ralph Acampora, all sort of setting the stage for the new ACP. This is our new advanced charting platform, which you can access now at stockcharts.com/ACP. But we will be doing here is just highlighting some of the features, some of the functionality, and how traders, investors can apply it into their own thinking. So check it out on September 22nd, introducing StockCharts ACP. Let's get to our market recap. And as you probably know from hopefully from watching the show, we do a lot of polling on StockCharts TV on our page. So if you're watching this on our StockCharts TV page on the right side, there's always an active poll. If you're watching this on YouTube, checking this out on Twitter, other social media, we feed polls as many places as we can just to help gather comments from you and help it be part of our perspective looking at the overall markets. Recently, we asked you, will the next 10% move in the S&P be higher or lower? And it's interesting, depending on when you answered that question, because I think we posted it on Tuesday or Wednesday. So depending on when you answer that, the answers may have evolved very quickly. But final tally is in. 40% of you said higher, 60% of you said lower. So looking at a chart of the S&P right here, we're at 34.26. So you give us 10% above that, it's about 350 points. That would put us at, wow, 37 something, 3770-ish. That's a pretty steep move up from here. It would take us above 3,600, which is the peak from earlier in the week. 10% lower from here would be down in the 3,100 range. That would be down around the 200-day moving average, if not a little bit above that. Certainly in that consolidation area. What's interesting is a 10% move sounds really severe, but given just the last couple of days, 10% is not hard to tweak, and certain stocks, obviously like Tesla and others, hitting 10% moves in a day. But overall, I mean, that has been a more severe swing than what we've been used to. If you think about the long-term appreciation that we've seen coming out of the last couple months, for sure. But we're certainly entering an area where we have now immersed in an area of increased volatility, and those kind of moves could certainly become much more common. Looking just at how the markets played out today, so the S&P finished down about 0.8%, 34.27, and I, probably sounded a little less negative as I was giving the intro. That's just because it was down to 33.50 just before lunchtime. It recovered a lot of that, and for a moment was actually touching the zero line from yesterday's close, but overall still finished down 0.8%, totally fair. NASDAQ 100 down a little more, mid caps and small caps down a little less. So it was really the mega cap tech and communication services trade pushing things downward. It's stocks like Microsoft and others that are really feeling the weight of things, Apple, et cetera. The VIX is actually down to around 30, and hopefully you caught the conversation with Mark Young yesterday talking about the VIX. Also, Dave Landry had on the show on Wednesday, and he and I think it was after we stopped recording, we were talking a lot about volatility, and his point was, look, the high, usually we attribute stronger stocks with lower volatility, lower VIX, and we treat higher volatility with lower markets, right? Because it's more of a fear gauge. But remember, it's a volatility on a number of different instruments, which means it really is a measure of volatility, and volatility can happen in up and down markets for sure. So here we have a situation where stocks actually finished down, the VIX actually finished down as well, and that's totally possible and reasonable. Really a rotation away from bonds into stocks. If you look at the two of those and how they went into the close, certainly going into the later part of the day, that's sort of what happened. So the TLT finished down almost 2%, and 10-year yields are back above 70 basis points. Gold and silver held up just fine. They actually sold off in the morning, but rallied pretty well into the close, with the GLD and the SLV both up. Silver up almost 1.33%. Let's look at a chart of the S&P 500 just to reset. So as we talked about this week, we've for a while now been talking about breadth conditions, and in the last couple of weeks for sure, we've talked about an extreme up move in price, a lack of confirmation from breadth from any way that you would measure it. Looking at cumulative advanced decline lines, looking at the McClellan oscillator, looking at other whatever measures you want to do about participation. It spoke more and more to a small number of large stocks driving the market higher. And the problem with that, the challenge with selling when you get that sort of signal, is the market can continue higher for a while given those conditions. It just tells you to start looking for the indications of downside reversal. And we certainly got those toward the end of the week here. On Wednesday, the S&P finally became extremely overbought. And my general base case, seeing that, is to expect a couple of things. One, you'd expect a pullback because, again, it's overbought. So you expect a move out of that overbought region. And then you'd usually expect at least one more push higher. And that's because the upside momentum has been so strong going into Wednesday's peak. It's unreasonable to think that buying interest would completely dry up and that would be it. Usually there are at least some subset of investors that will buy into a dip like this. We saw that going into the close today. When the S&P hit 3350, that's the low from mid-August. All of a sudden you see the rally, and we closed about midway through the range for today's session on the S&P. So, buyers coming in going into the close, and I think going into next week, you certainly could see a bit of a bounce. And then I think you may see more further downside. And that's when I think we'll have to focus on some of these other levels. I will tell you that conclusion is incorrect. If and when we break to new highs, we hit 3,600, I'll tell you that we're going to go much further than this potentially. But that's sort of the general thesis. So going into this, the next couple of weeks, this is where bearish divergences tend to flourish, especially not as much maybe on the broad S&P chart, but this is where you'll see it on a lot of individual stocks if this is what's actually going to play out. So it's definitely a good time over the weekend, wherever you look at individual charts, to focus on that. If and when we do distribute further, 3350, which was the low for today, sort of gives even more value to that range, that 3350 to 3400 range. That's the breakout level from earlier in August. That's the breakout level from February, the resistance from February. And this pullback to 3350, that was the floor we had last time. So we're right in that support range. So one of two things happens. Either this holds going into next week and we ride the next leg higher, or this fails, at which point I think you look even lower. here to 3,200 to 3,250. That'd be the most recent pullback. That's back to the June breakout, the retest there in July, and the pullback before the next leg higher. So looking at downside potential, that's where I would start to pay attention to things. Let's continue on just very quickly hitting on some themes. Then I want to get into the Mindful Investor Live chart list. It's really the core of our Wrap the Week segment here. Looking at sectors, I mentioned in the introduction financials, and if you look, the XLF was up 0.8%. I think there are a number of charts that are starting to look kind of compelling, and they're on the short term, that tactical time frame. So as money's rotated away from tech, communication services, it appears to be rotating into financials, into industrials. And we did a deep dive on industrials earlier this week. If you missed that, I think that was on Wednesday's show, or maybe Tuesday's, but go back to those and check it out, because we hit on some of the groups within industrials that we're starting to look potentially kind of interesting there. Let's continue on looking at the Mindful Investor Live chart list. So the way we start this out is looking at the market trend. I define that in 3 time frames. The long term is looking at the 21 and 34 week exponential moving averages. That has been bullish since early June. The medium term time frame is using the weekly PPO, using the traditional settings. That went bullish in early May and has remained bullish through today. And then the short-term gauge that I would look at is just the price relative to the 5-week exponential moving average. We actually traded below it today, but closed back above it. So that signal is actually remaining short-term bullish for the week. And again, it's worth pointing out the weekly charts are really helpful in a week like this to show that even though it was distributed, and if you look at a lot of daily charts, you'll see a lot of pain in the last 48 hours. But if you look at the long-term trend, we really haven't even broken down through the most simple, basic, starting point support levels, right? We're nowhere near really painful breakdown levels. So let's keep a good perspective on what this week's sell-off means in terms of the long-term trend, which is pretty much in good shape. Here's the updated support levels that I see for the S&P 500. I don't have the resistance here, but again, we now have a clear peak just below 3,600. That's the level I'd be looking around. It's around 3570, 3580, and that's where I'd be looking at any sort of rally from here. You'd expect that to hold. If it breaks, expect further upside beyond. Look at the breadth here. I color-coded these amber because the S&P advanced decline line made new highs this week. And this is not updated yet through today's close. They'll probably come off a little bit as a lot of things, sold off today. But overall, it's sort of neutral for the broad common stock universe. If you look at mid caps, if you look at small caps, especially, it certainly speaks to a neutral reading, right? We've made a lower high potentially. If we would break down through the swing low from that 3rd week in August, I'd be concerned about much further downside. And this is sort of normal, right? When you get a market top, and if this continues to see topping patterns, the sort of traditional bull market playbook would be a rollover in small and mid caps first. That's usually where you see internal weakness. And then the last thing to roll over would be the S&P advanced decline line. And that's sort of what happened back here in January and February. That's what I'd be looking for here, but still neutral in a lot of ways. This is another one, the spike that you saw in new highs on the S&P 500, that was Wednesday's session. Almost 20% of the S&P made a new 52-week high on Wednesday's session. That's Thursday. We don't have today's reading just yet because we're processing all the closing prices right now. But it's worth noting that we obviously came off a good amount. I would think this is pretty minimal today. So this, you could see this as potentially a bit of a capitulation in that it was a huge spike, much more than what we've seen. But it's worth noting that in more mature bull markets, this line can go a lot further, right? So if you look back here to January, which was actually the first peak, wasn't the eventual end ultimate high there in early 2020. But the peak was actually above 20%. It was almost 25%, a little bit more of the S&P made a new 52-week high on one day. So, while it has been an extreme relative to where we've seen it over the last 6 months, it's nowhere near as high as it's been and remained in more extended bull market phases. But that speaks to, I think, the severity of the sell-off in February to March. This is one measure of breadth that's worth revisiting here, and this is the percent of stocks above their 50-day moving average and above their 200-day. This is the S&P stocks above their 200-day in blue and the percent above their 50-day in green. I posted this earlier this week, and some of the comments I received back from people was, look, I know the market's down, but still it's like over, almost 80% of the S&P still above its 50-day moving average. And I think That is absolutely a valid point. I think it's worth noting, as long as this remains up in these levels, what it tells you is stocks have sold off very quickly, very suddenly. That's totally fair. Some stocks have really lost a lot of value in a couple days. That's totally fair too. But if you look at where they're at relative to their simple 50-day moving averages, most stocks, 3 out of 4 at this point, have remained above their 50 days. So even though they've pulled back, they've just pulled back a little bit. They really haven't, broken down in any meaningful way. It's still within the range, and a lot of stocks are still, above where they were a week ago, right? So it's unreasonable to think that just based on what we've seen alone that you can expect further downside. I think the conditions are right for that sort of move, but I'd want to see more confirmation elsewhere. And for me as a long-term investor, looking at the percent of stocks above their 200-day, you see stocks getting back down to their 200-day moving average, you can start to get worried about the need to get a lot more defensive than we've been. This is the AAII survey, and again, anytime I say anything about this, I get a lot of people that this is a very polarizing thing I'm finding, and that's great. But people have strong opinions about the validity of this information. So totally granted, this is a subset of investor. It tends to be it tends to be a small group of essentially retired long-term investors as part of the AAII that are, giving their weekly responses. It's a couple hundred votes every week, and that's it. Having said that, it's something I followed for so long. I've just gotten used to the value of it. And I think, it's worth noting that based on this one data point, the level of bullishness is below the level of bullishness we've had at previous highs. And Mark Young, my guest yesterday, sort of made a good point of that. Well, we're out of time. I just want to hit on just a couple more quick things and then we'll wrap here. The relative performance of semiconductors, I think, is a really important thing to watch here as we think about the rotation away from technology that we saw going through today's close. We potentially have put in a lower high here with the relative strength of semiconductors. If this continues to rotate lower, that would be one of those bullet points in the bearish watch list. And again, semiconductors have been such a strong performer for so long. I think it's something to be watching for, but again, it's still early on. And another early on but worth watching is growth versus value. Growth has been over the long term outperforming value for longer than I can remember. We've pulled back in that ratio. That's totally fine. That's actually happened a number of times in the last couple of years, and 100% of the time it's tilted back toward growth. So until I see something otherwise, I'm going to assume that the growth rate is still very much alive until this ratio turns down with some gusto. We're going to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We love the interactive nature of the show, and it's been a pleasure to get to know many of you through your questions and your feedback on the show. Please keep them coming. You can get to us two ways. One is the Final Bar at StockCharts.com. Just shoot us an email anytime. The other one on Twitter, tag us in a comment at FinalBarSCTV. Third is on YouTube. Anything that you see us put up there, just put a comment below the video. We capture all of those questions and we get to as many as we can. And right now I'd like to get to the Final Bar mailbag. Question number one, great show, David. I agree that trading is more sentimental than technical. I like the way you said that. However, I use Bollinger Bands and Keltner channels. I use the difference to see if Bollinger Bands are squeezed inside Keltner channels. That's my bullish indicator. I asked if we can plot this against each other on a chart. So I'm actually using, it's a great question. I'm actually using the new StockCharts ACP to do this. It's pretty easy to set that up. You set up a chart, you go up here to indicators, and I just picked Keltner channels and Bollinger Bands from the list and changed with the settings and the colors just to try to illustrate the point we were talking about. What you were basically saying is I'm using these two types of bands. And if you're not familiar with it, we can't get into too much detail, but Bollinger Bands are here in yellow. The Keltner Bands are here in pink. They're calculated in two different ways, but the way that Bollinger Bands are calculated, which is based on standard deviations around a moving average. So I have a 21-day moving average or 20-day moving average, which I've hidden here in the middle. And then this is showing you a rolling 20-day look back. What's two standard deviations above and below that moving average? And that's what the white bands are. The pink lines are the Keltner channels, which tend to be a little more a little more narrow. And what your comment was, I look for when the Keltner channel, sorry, when the Bollinger Band is squeezed inside the Keltner channel. What you're actually doing there is actually kind of interesting. The Bollinger Band's tightening up, a low Bollinger Bandwidth, is because of low volatility. So when the stock becomes less volatile, this is Apple we're looking at, when the volatility tightens up, when it tends to be a little more consolidated, or when the trend starts to slow down, you'll see the Bollinger Bands come inside the Keltner channel, and that's because Keltner channels are built on average true range, which means it's going to, it's going to be based on the movement there. But the Bollinger Bands are based on how far it's moving away from the longer term trend. So because of the differences, you're going to, that signal is going to signify lower volatility environments. That is all great. What concerns me is your comment about that's your bullish indicator, because that's true in a cyclical bullish environment, which you've arguably been in. If you look back here in January to February, you saw that phenomenon where the Bollinger Bands came within the Keltner channels. They actually broke lower there, right? Because you had lower volatility going into the peak, and then things started to sell off. So I think you're oversimplifying a little bit if you consider it a bullish indicator. Is it a breakout indicator? Absolutely. And that's not exactly what John Bollinger did using Keltner channels, but that is certainly what he's talked about in many places. And I've spoken with him about that, prospect of narrowing volatility before a big breakout. So I would not assume that as a bullish indicator. It's definitely a breakout indicator, and I would look for the direction of the move. Question number 2, we had a question, and I'm paraphrasing, here's a long question about, can we scan for high scooter stocks where the scooter ranking has a low standard deviation and a low average true range? And actually, you sent a great way to do that. You actually said, what about this scan? I think you're absolutely right. We're going to go to the scanning engine. We're going to click on scans. I'll say new scan, and here we go. So what you basically said was put this line in the scan, which I will now do. Let's see, and daily min 30 SCTR greater than 95. So what you're doing by this, and again, I'm sorry I can't go into too much detail on this, but if you're unfamiliar with the scanning engine, look at our Chart School articles, or Chip Anderson, the founder of StockCharts.com, has recorded some great videos on how to design some of these scans. What you're basically saying is the lowest value for the last 30 days on the scooter ranking is 95. So it's not gotten below 95. So while that's not actually looking at standard deviation or average to range, you're kind of getting there. You're backing into it by saying, I only want stocks that have remained in the top 5% for the last 30 days. I think that's a beautiful way to do that. And that will give you a small group of stocks that have remained relatively strong over the last month. I think it's beautifully done. Well done. Question number 3, thanks for the awesome commentary. You're welcome. My question is, what kind of stop loss strategies are good? I literally went 15 years as a buy and hold investor. I'm sorry for that, which was fine at the time, taking those 40% haircuts along the way. But now I want to get smarter and at least understand, right? So what were you talking about is just the different ways to think about stops. So it's a little outside the scope of what all we could talk about just in the show. But I would say, in general, when you're thinking about stops, I love the fact that you're asking about it, because what stops allow you to do is basically bump up your downside risk and minimize your downside risk. When you go into a long position and the price goes higher, you're bumping up your stop using something, and I'm referring to a trailing stop, right? Which is basically, you have some methodology to continue to move up your risk. And so when you finally break down through it, that's when you exit it. There are 3 ways in general that I've seen people do that. One is using a simple price stop, which means every time the market makes a higher low, you bump up the stop. So if you were a genius and bought JPM here in early October and we keep going higher, you bump the stop up to there, you bump the stop up to here, you keep bumping it up. And as we make higher lows, you bump it up. And when we break down through your most recent stop, that's where you exit it. Option number 2 is using something like a moving average, just using the 50-day moving average and looking for when stocks you own break below the 50-day is a great way to, great reason to revisit some positions and think about whether you want to remain in them or not. The third one is using something about volatility, something like average true range or something like that. And we have like the chandelier exits and others that are built into stock charts that can help you capture that. So some sort of trailing stop that locks in gains and gets you out relatively quickly, locks in the upside as your position continues to work. I'd certainly suggest looking deeper at some of those. Next question, would love to hear about log charts versus standard charts, excuse me. Do you always stick with log charts? Any exceptions? So my answer is 100% of the time I use log scale charts, and that comes from it being beaten into my head for my time at Fidelity. The chairman of Fidelity was a stickler for log scale charts because his argument, which is totally fair, is that as a long-term investor, log scale charts tell you your performance on a percentage basis. So what it's doing is the y-axis is driven by percent terms and not by price terms. So as a market moves, the movement on the y-axis is based on a percent move. So I always use them. The time when you don't really need them is if you're a shorter term investor. If you're looking at a 1 day session or even a week or a couple months even, log scale is less relevant because the market's not going to move enough, most likely, that it's going to impact the scale so much. Of the log and arithmetic scales are going to look very similar. On a long-term chart, if you look at like a 30-year chart, you are completely ruining the analysis if you do not use log scale charts. So you really need to do so. Your final question that we'll answer here. I really like the analysis on your YouTube channel. That's great. I like your chart style and settings. I'm more interested to know how I can do similar advanced settings like what you have, like chart layouts, Fibonacci retracements, etc. I will tell you how I learned stock charts. I've been using stock charts for a number of years. I've gotten better and better at it the more I've used it. And to be honest with you, the way I really learned how to use this system well is I watched hosts on StockCharts TV, and anytime I saw something that I liked, I tried to recreate it on using the Sharp Chart system. And I'm finding the same thing with ACP. When I find something that I like, I very gratuitously borrow it and put it into my own platform. And all the charts that I've shown you in some way have most likely been inspired by something I've seen from guys like Tom Bowley or Grayson Rose or Julius DeKempener or Arthur Hill, some of the guys that really are power users of the platform. So my encouragement for you is watch how people are using the product on StockCharts TV, also on social media. There are a lot of people that use this platform really, really well, and copy what they do. I found most people are actually super generous about sending charts that they're using. And by the way, any chart you see me using on the show, just shoot me an email, thefinalbar@stockcharts.com. Tell me as specifically as you can what chart you're looking for, and I'm happy to send you a permalink, which means you can put it right in your own log, and I'm happy to share it. That's our mailbag for today. Those are all questions we've gotten in the last day or two from you. Really appreciate you guys sharing your journeys and how we can help you. We need to wrap this show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at our market trend model. I use a very simplistic trend following model based on long-term weekly exponential moving averages. My point of bringing this up is as of the close today, even with the distribution we've seen in the last 40 to 8 hours, long-term, medium-term, short-term, all remaining bullish. The first thing that would turn here would be the short-term indication, which is where the price is relative to its 5-week exponential moving average. We traded below it today, but did not close below it. So at this point, at the end of the day Friday, it's still overall positive, which again, I think is fair based on how far we've come off, which is not very far relative to the long-term trend. Chart number 2 is looking at technology. This is the chart of the XLK, and I want to focus on the relative strength on here. I mentioned how semiconductors were rolling over on a relative basis, and that's true if you look at the last week or last couple weeks. But overall, it's worth noting that the XLK has been a long-term outperformer by any measure, right? Looking back since the December 2018 market low, the XOK has just been an incredible source of performance. So even with the dramatic sell-off we've seen in mega cap tech and pain we've seen in charts like Apple and Microsoft and elsewhere, it's worth noting it still hasn't even broken down a trend line using the lows from the last couple months. So let's keep a proper perspective that overall the relative strength on a lot of these charts is still very positive, meaning if you're going to be in equities, it still, I think, makes sense to be in some of these sectors, even that have gotten beaten down. When these relative lines start to rotate lower, when the RRG charts start to show rotation further away from technology, that's when I think you want to start to consider lightening up or think about where your bets are placed and focus on opportunities where, potentially in places like utilities, financials, and others where you're starting to see improvement in the relative strength profile. Finally, I just mentioned financials, and I think when I'm looking at the market over the last 48 hours, I'm looking at what has worked. I'm finding charts like COF that are popping above their previous swing high. So, again, Capital One still below its 200-day moving average, which is descending. It wasn't able to get above there in June. So I'm not saying this is my most perfect chart in the world, but overall, I have to recognize that when the market's struggling, the stock is actually rotating higher and actually behaving really, really well. We had a new 2-month relative high on this upswing today. So I'd be looking at charts like this. Over the weekend, I do my review of the S&P 500 charts. I'll be interested to see what sort of opportunities I see in financials, industrials, utilities, some of those other places. Folks, that's a wrap for this week. Thank you so much for joining us on the Final Bar every weekday after the close to break down the market's activity. As a reminder, we're going to take Monday off for Labor Day. Hope you have a wonderful weekend. Recharge, refresh. We'll see you back on Tuesday. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.